Welcome to The Explainer. Today, we're diving into an investment that, on the surface, looks a little strange. It's the TVS Infrastructure Trust. Its returns seem pretty average at first glance, but when you look under the hood, there's a clever financial strategy that could unlock some really impressive growth. Let's dig in.
So let's start with the central puzzle here. When you first look at the TVS InvIT, it offers a distribution yield of about 5.4%. Now that's actually lower than some of its peers, which might make you scratch your head. So the big question is, how on earth do you get from a 5.4% yield to a potential 12 or 13% compounded return? Well, to figure that out, we have to look past that headline number and into the very bones of the trust.
And to solve this puzzle, we have to start right at the foundation. You see, the whole thing is built on this single, really bold financial decision they made about their debt. It's a move that's so long-term, it completely changes the risk of the whole investment.
Think about it. Most businesses are on this constant cycle, right? They're refinancing their debt every few years, and that leaves them totally exposed to rising interest rates, which can just demolish their profits. TVS decided, you know what? We're getting off that hamster wheel. We're going to take a radically different long-term approach.
So what did they do? They went out and secured debt with a 20-year tenure. 2 full decades. I mean, for this kind of financing, that is almost unheard of. It's a move that just screams stability, not short-term wins.
But, the length of the debt, that's only half the story. They also locked in the interest rate at just 7.42%, fixed. For the next 20 years, their biggest single cost is completely predictable. It doesn't matter what the market does.
So, here's the crucial part. They've locked in a profitable spread. They're borrowing money at a fixed cost of 7.42%, and they're putting that money into high-quality industrial assets that are kicking off a yield of around 7.75 to 8%. What they've done is create this incredibly predictable cash flow engine that's completely shielded from interest rate risk for 2 decades.
Okay, so they've locked in their costs. That's one side of the equation. But what about their income? A fortress isn't much good if the money flowing into it isn't just as secure. And that brings us to their tenants.
You see, unlike a lot of their competitors who are chasing after e-commerce giants, which can be a pretty volatile business, TVS targets a completely different kind of tenant. They focus on industrial manufacturers in places like Pune and Chennai, really the heart of India's automotive and electronics manufacturing industries.
So why are these tenants so sticky? Well, think about it. Moving an e-commerce warehouse is a pain, for sure. But moving an entire factory? That's a whole other level. You can't just pack a multi-ton press into a moving van. The cost and disruption are just massive. These facilities are absolutely critical to their operations, which means TVS gets nearly 100% occupancy and incredibly predictable rent checks.
Now, this combination of fixed debt and super sticky tenants creates a really unique profile in the market. You'll notice how its peers often use riskier, floating-rate debt. TVS is making a trade-off. They're sacrificing a slightly higher yield up front for something much, much rarer, a top-tier AAA credit rating, and a financial structure that's built for the long haul.
Okay, so we've got a solid foundation, fixed debt, sticky tenants. Now let's connect all this back to our original question. How does all this stability actually lead to potentially high returns?
The total return here isn't just about that initial 5.4% yield. It's really a 3-part story. First, you have that base yield. Second, baked right into the leases are automatic rent increases of 4 to 5% every single year. And third, the trust can use its cheap debt to go out and buy new properties, which grows its cash flow even more.
Of course, the total long-term return. A big part of that depends on what the market looks like when these assets are eventually sold, way down the road. You can think of the exit yield as basically the final sale price. What this table shows is that even if the market isn't as hot as it is today, the projected returns are still really strong. But if the market stays healthy, well, those returns push way into the double digits.
And here is where the magic of compounding really kicks in. The returns we've been talking about are if you just take the cash and put it in your pocket. But if you reinvest that cash back into the trust, the growth just snowballs. Reinvesting those regular payments is the secret sauce that could potentially push the total return from around 11% all the way up toward that 13% mark over the long run.
Okay, but let's not get ahead of ourselves. No investment is a sure thing, and it is absolutely critical that we understand the potential speed bumps for TVS InvIT before we jump to any conclusions.
So the first big risk is this timing mismatch. The debt is locked in for 20 years, but the average lease only lasts for about 5.5. That means that they've got to renew these leases multiple times before that debt is paid off. Now, the main defense here is what we've already talked about. These tenants are so deeply invested in these specific properties that they are just incredibly unlikely to pack up and leave.
The second risk is concentration. A big chunk of the portfolio is tied to the auto industry, and that industry has its ups and downs, right? So if the car market hits a rough patch, that could affect several properties all at once. The buffer they have, though, is their presence in other growing areas, like all the electronics manufacturing happening around Chennai.
And finally, there's the risk that just comes with growth itself. The trust is planning to borrow more money to buy new assets. And while using that leverage can definitely juice your returns when times are good, it also magnifies your losses if property values start to fall. It is the classic double-edged sword of real estate.
So after we weigh this really unique financial setup and these super sticky tenants against some very real risks, what's the bottom line here? What's the key takeaway on the TVS InvIT?
The entire investment thesis really boils down to this one idea. You have to look past that headline yield to see the quality underneath. The argument is that the incredible safety of its AAA-rated balance sheet, combined with that long-term growth potential, makes the current price a pretty attractive entry point.
And this slide really sums it all up nicely. We're looking at a huge, highly rated portfolio of industrial properties. But the key differentiator, the one thing to remember from all of this, is that one-of-a-kind 20-year fixed-rate debt structure. That is the bedrock of stability for this whole thing. Which brings us to our final question. And the whole story really comes down to this. In a world that's filled with economic uncertainty and wild swings in interest rates, what price are you willing to pay for 2 decades of stability? That's the real question at the heart of the TVS InvIT. Thanks for tuning in.